Hi, this is Christian Dye from Latitude West Financial. Thank you for joining me. Today, I want to talk about the shocking truth about ETFs in 2025. So, I work with a lot of physicians, a lot of dentists, and they always ask, why ETN index funds are ideal for high income earners. Well, there's three quick reasons. There's time constraints. They're very, very busy professionals. And so they don't have a lot of time to be dealing with their investments. There's simplicity of passive investing. So ETF index investing is very, very passive in the way that you don't have to manage the funds, and you still get very, very solid returns over the long term. And then there's of course saving on fees. Investment fees could be as high as 2%, whereas index fund investing could be as low as 0.2%. So in the long term, you're going to end up saving quite a bit of money. So that's why a lot of people invest. That's why we encourage that people invest in ETFs as well. So what are some popular ETFs? Vanguard has a series, VGROW. This is an 80% stocks to 20% bonds made up of international, Canadian, and US. Very low MER, 0.24. And if you take a look at their long-term average, their 5 years about 9.7, but since inception, it's about 8.6. So that is a pretty good rate of return considering it is a passive investment. Another very popular one is VBAL. So this one's a bit more of a balanced one. If you want less volatility in the stock market, this one has a 60-40 stock to bond mix, depending on your risk tolerance or as well as your age and how close you are to retirement. This one's had about a 7.3 5-year history, and since inception, about a 6.8. And then the other very popular ETF is a pure stock one. And this one here, it's 100% stocks made up of a variety of different indexes, but it has had since inception about 12% rate of return. So these are some really good ETFs for people who are ETF investors. You might be already investing in a few of these. So then that brings up the next question. Well, what is wrong with only ETF investing? So why don't we just do this? And I think the point of this video is to try to explain why the smartest investors on the planet don't do this. If they're so smart, then why don't they just save on the fees and do some ETF index fund balance investing? There's three main reasons. There's risk versus reward. The other one is the opportunity cost. That's of course the opportunity of what they're leaving on the table with other investments. And then, of course, there's the lack of diversity. They're going to go up and down with the volatility of the markets. So let's start with risk versus reward. There's something called the Sharpe ratio. It's a mathematical formula that measures how well an investment performs relative to its risk. So a Sharpe ratio, you want a very, very high Sharpe ratio if you want, the reward without the risk. So, Bitcoin will have, of course, a very, very low Sharpe ratio, whereas real estate will have one much higher. So as a measure, if you're less than one, that's considered not optimal. Between one and two is adequate. Anything over two is considered good, and three or more is excellent. To give you a bit of a kind of a range over here, um, real estate in Canada is usually in the twos. So that's to give you an idea of well, how often does Canadian real estate, go down and stay down over the course of 20 years? It never has. The stock market, of course, an individual stock will have a much lower Sharpe ratio because, of course, it could devalue down to nothing. So now that we understand risk versus reward, let's relook at VGROW. Vigro at the very bottom over there, Sharpe ratio is 0.4, and it's got a standard deviation of 11.2. So for those of us who remember our stats class, what is a standard deviation? It's kind of the volatility. It's basically thinking of it, sure, it has an 8% rate of return since inception, but at a standard deviation of 11, which means it can have quite large swings. If we take a look at VBAL at the bottom, Sharpe ratio is 0.21 and the standard deviation is 9.9. So the standard deviation is lower because it's less volatile because of the bonds, but for the risk versus the reward is actually much lower. And then if we look at the VEQT, now the standard deviation is high, almost 13%, but the Sharpe ratio is also a little bit higher. So now we have to balance a couple of different things, not only the rate of return, but also the standard deviation as well as the Sharpe ratio. So if we look at a pure S&P 500, and a lot of people they might want to use this as the kind of the baseline metric. Now the S&P 500 since 2007 has returned 10.53%. Most people are that's what they're aiming for, sort of a 10% rate of return. But look at standard deviation, 18.1. So you have a very, very, very volatile market. So look at 2024. We ended at about 26%. In 2023, 24%, and then we were down negative 19. And then before that, 26. So statistically, you might say we're looking really, really good, but actually it's not looking very, very good because historically, how many times have you ever had 3 years in a row in the double digits or in the, or over 20%? Very, 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 very rare. And as a matter of fact, in the last 20 years, it has never happened. So many people are saying, well, we've probably gone up too quickly, too fast, especially when you have one, two, three, four, 4 years over the last 6 years. Let's see, one, two, three, four, five, six. Yeah, at the last 6 years, you've had 4 of the years that are over 20% return. But if you look at our history over here, what can we actually expect? Well, you could probably expect that that is going to level off. And that's where, of course, we get the volatility, risk versus reward. So if you were to say the S&P 500, if we just did an ETF in the S&P 500, if we took it from 2010 to 2024, ending 2024, so that's 14 years, what has our rate of return been? And it's actually been really good, 14% per year. If we adjust this for inflation, it's about 11%. So you would say, well, that's fantastic. That's the return that I'm looking for. But it depends on the time frame you take. So now let's take a look if we took it back just another 10 years. If we went from 2000 to 2024, you actually only got 7.9%. So now we have a longer time frame to look at. At 24 years is going to be more accurate than 14 years. So what we find is that relying only on ETFs, relying solely on markets, the stock market, you're going to get all of this volatility over here, which is why the smartest investors in the world don't just invest in ETFs or in the stock market. So I want you to imagine this. I want you to imagine that you are a high income earner and you had a high net worth family. And you took your high net worth and you decided to not only hire one individual, but an entire team of individuals, tax, legal, finances, accounting specialists. And you said, okay, I'm going to hire you guys as a team, and your job is to outperform the benchmark, because if I wanted the benchmark, I would just do ETF investing. I want you to minimize taxation because I'm a high income earner and I come from a high net worth family. I want to reduce the volatility risks. I don't want to take 18% standard deviation of risk as well as a really low Sharpe ratio. And I want to diversify my assets in order to protect my overall portfolio. Well, this exists. This is called the single family office. So family office model is getting more and more popular because, of course, there's more and more wealthy individual families and generational wealth that's going out there. So the ultra high net worth family often will hire a single family office team. So it's a team that's privately dedicated to just their family's net worth. So Right now, usually the minimum is 250 million in assets, but the average net worth of a single family office is about 3.8 billion. What they pay in fees is usually north of $1 million. There is now 8,000 SFOs worldwide. 10 years ago, there was only 3,000, which goes to show you that there's more and more and more of these very, very wealthy families that are on this planet now. So usually they'll have a team that invests just solely on their money, and their goal is to outperform the benchmark. Okay. So let's take a look at the latest report as to what participation they are investing in. So if you take a look at assets under management, you'll notice that over 50% of them have over $1 billion. So these are very, very, very high net worth families. So what do they invest in? There is a 90% participation rate in private equity. So right now you've got all of these ETF investors investing in public equities, doing ETF investing, and they're saying, I'm smarter than everyone else out there. The smartest people on the planet are not doing this. There's a 90% participation rate in private equity. And in a recent study by RBC, they said for the family office investors, do you agree with the following statement? The private markets will continue to outperform the public markets over the long term. 75% agreed. And this over here is a bit of a demographic of what they are investing in. They will do private equity direct, or they will do private equity in the form of funds. There's an 89% participation in single family offices in real estate. And if you know Latitude West, we're very, very pro real estate. We're not going to talk about real estate in this video, but we are going to talk a little bit more about what single family offices are doing. So right away, ETFs, and when we talk about real estate, we are not talking about REITs. We are talking about, or not just REITs anyway, we're talking about direct ownership real estate. So when we talk about these wealthiest investors in the world, and on one of our other videos, you've probably heard me talk about the Tiger 21. So the Tiger 21 are probably the wealthiest peer networking group on the planet. $10 million their minimum investment, and the average investor has 100 million. What I want to point out in this graph here is um, in the top left-hand corner is public equities. That would be the stock market. That would be your ETFs. They only invest 21% in it. If you look at the bottom left-hand corner, they have about an equal amount in private equity. So the smartest investors in the world are now investing in both public and private equity almost at the same rate over here. So what is private equity? So private equity is simply not a publicly traded company, but it does invest other people's money. Now, it's typically for an accredited investor or high net worth investors. So unfortunately, not everyone has access to this. You know, the average Canadian family will not have access to all of the private equities that a high net worth or an accredited investor does. So the characteristics is typically that it is less liquid. So usually people are leaving it in for much longer. It could come with higher risk depending on what it is you're doing. So the way to minimize that risk is to better understand the private equity and to diversify against other private equities. You don't want to invest in a private equity which is brand new that doesn't have a long track record. But if you have one that has got a longer track record with a good rates of return, then that would be, of course, considered a strong one. So, in a study done by the Cambridge Association of U.S. Private Equities, they have found that over a 25-year period, the annual average rate of return was 13%. Now, they compared this against the Russell 3000, which, of course, is the public equity market, and they had an average return of about 8.16, which is, about what our charts have also shown with our balanced ETFs. Now, what I wanted to talk about is risk versus reward. So what this chart shows by contrarianthinking.co is it shows the annualized returns versus the risk percentage. Okay. So what you have here on the y-axis is the return, starting at 2%, going as high as 14. But the further you go along the x-axis is the historic annualized volatility. So you'd say, well, what is the most volatile yet also has the highest amount of risk? It's emerging markets in equities. The Russell 2000 is even more volatile. The S&P 500 sort of lands here in the middle. But one thing that I want to show to you is this: private equity actually historically has a higher rate of return with a lower risk annualized volatility. So it's no doubt why people who are of high net worth will not just invest in the stock market, but they will also have a portion in private equity. So Tony Robbins recently wrote a book called The Holy Grail of Investing. And in his book, he is interviewing high net worth individuals, as well as hedge fund managers like Ray Dalio. And in the very first two chapters, he talks about private equity and how the majority of people don't understand why, in his opinion, this is a complement, a non-correlated asset, but it actually has a higher return inside the stock market. So he did a 40-year study, and he found that the S&P 500 in the last 40 years, 1983 to 2023, returned about 9.2. Our independent study showed pretty much the same numbers. But his study of private equity market as a whole returned 14.28. Then to kind of show you what the ramification is, if you had $100,000 and invested it over 40 years at 9.2%, you'd have about 3.3 million. If you took that same $100,000 over 40 years at 14%, you would have 20 million. That shows you the difference that 5% can make, which is why he's trying. All the proceeds of his book is going towards charity. He's not taking any profits on the book, but what he wanted to do is he wanted to try to give the investment secret formula that was only available to the rich. And now it's sort of available in his book. And he's describing why people should be investing more in private equity on top of the public stock market. So why not to only invest in ETFs? Okay. One, you want to diversify. You don't want to ride an 18% standard deviation wave for the rest of your life. But you also want something that is not correlated to the public stock market. So private equity is not correlated to public equities. And you on historically, you actually have had higher long-term rates of return. Now, I should just make sure that you understand that that's if you pick a good diversification of private equities, not just putting all of it into one. So now here are the challenges of investing in private equity. One of them is finding a good private equity investment. It's kind of like going out trying to find a good stock. It can take you a while to go find it, and you might not even find it because you might not know exactly what you're doing. Oftentimes, private equity requires large capital appreciation, so $100,000 minimum, $250,000 minimum. And then there's qualification. You'd have to be an accredited investor. Sometimes with these private equities, you actually have to have someone bring you in who's already on the inside. They just don't take anybody's money. So now the good news is the landscape has changed probably in the last 5 years, that it's easier for individual investors to invest in private equity through EMD advisors, for example, and then they would have the responsibility to kind of going through what's inside all of the different private equity investments that they have access to. So now they are RSP and TFSA eligible, as well as, of course, non-registered, or for those of you who invest inside your corporation. It's just that people don't understand it. People have trouble finding it. Your traditional investment advisor sometimes doesn't understand it or isn't qualified to invest in it. And I know with us and our team, we want our clients exposed to both because we believe in the formula that the ultra high net worth have been investing in for essentially decades. So um, I'm not going to share the name of these public equities, but I'm just going to share two. There's probably about eight or nine that we really feel confident with in our practice. But here are two in general that I really like. One of them, it's actually got a very stable 10.5% rate of return. But what I like about it is the 4.7% annual dividend. So usually what I found in the public stock market, if I want something as high as a 4.7% dividend, which is very hard to find, usually their rates of return are also quite low, like a 6% with a 3% dividend, something like that, or a 7% with a 2% dividend. So I like this because it's conservative. This is my, go-to conservative public equity. Sorry, private equity. My public equity sample number two, this is probably my favorite one over here. Since inception, it's returned about 12. The 10-year average is about 13. But if we take a look at the last 14 years, this is what we're going to notice. Several years have double digits, some as high as in the 20s, but there is no negative year. And that's the point. There is no negative year. So you might look at this and says, hey, I can get the S&P 500 to do the same thing. I get double digit years. Yeah, but you also get double digit negative years. Whereas this private equity has never had a negative year, nor has the first one never had a negative year. And that over there is something that I like. Rule number one, don't lose money, right? Um, Something to point out with this private equity as well. Um, this standard deviation on the S&P 500 is in the same time frame has been 14.1. The private equity standard deviation has only been 5.1. So I'm basically dramatically reducing my risk, yet getting, fantastic low double digit returns. So this is a diversification. I would have, some money in private equity sample number one, some in private equity sample number two, as well as probably three or four different private equities on top of my ETFs, on top of that, in order to have one, non-correlation, and two, diversification. So, why do I believe ETF investors need both public and private equity? So, here's what the numbers shake out as, okay? So, if you invested $100,000 annually, and we work with a lot of physicians who are incorporated and are leaving money inside the corporation, usually around, 100, 200,000. So, if you invested $100,000 annually for 30 years, and if you just put this in Vanguard's balance, ETF, VBAL, they had an average of a 6.8%. So if they continue to have that 6.8%, in 30 years, you have 9.1 million. Nothing wrong with that. Standard deviation of 9.9, nothing wrong with that. Nice and low. In case two, if you used VGRO, and they had an average of 8.6, but they had a higher standard deviation of 11, you'd have 12.653 million. Now, if you went with a nice aggressive, just pure S&P 500, you'd have a rate of return of about 10.5. You'd have a heavy standard deviation of 18.1%, but you'd have $18 million after 30 years. Now, what if we combined a split 50-50 of public and private equity, and we just use Tony Robbins' historical average? Okay. Now, if we combine both of them together, we would have about a 12.74% ROI, but a 9.3% standard deviation. So now I've got a standard deviation as low as VBAL, but instead of a 6.8 ROI, I'm getting a 12.74. So what is the difference over 30 years? We're talking $27 million. If we compare that to case number one, we're triple the value with the same standard deviation. So you kind of see why the single family offices, why the Tiger 21, why ultra people who are high net worth will combine private equity into their portfolio and not just have ETFs. It's great if you're having ETFs. It's simple, it's passive, but so is private equity. It's also simple and it's also passive. So, how do you invest in private equity? Well, one way is to go find this on your own. Now, if you go actively seeking out private equity firms, you absolutely can do that. It's like trying to buy stocks or individual stocks. Um, so remember, but they're not publicly traded. Because they're not publicly traded, it's going to be much harder for you to try to find them on your own because there's not going to be an ETF version of this. Okay. Usually the minimums are quite high. Their MERs aren't zero point 0.2. They're usually a standard, probably about 2%. But remember, everything I've shown you is after fees. So you are going to be paying more in fees. So if you absolutely hate paying fees, you might not like private equity because they have built-in MER fees. Um, and you got to leave the money in there longer. It's not like, with an ETF, you could put the money in 1 month later, you could take the money out. With private equity, they don't want that. You should be looking to leave the money in, 3, 5, 10 years. So it's for the long-term money for sure. So how do you invest in private equity? One, go find the companies on your own. The other way, of course, and this is what a lot of our clients do, they want an EMD advisor. That stands for Exempt Market Dealership Advisor over here. And that way we're doing the research for you over here. You're also saving on the MER because we can take a look at which is the one that's best suited for you based off of your scenario, as well as the tax efficiency. So, what do I mean by tax efficiency? Some of them aren't as tax efficient as others, depending on the makeup and depending where you put it. Like in the corporation, RSP, RESP, TFSA. Especially being Canadian, some of them are Canadian based, some are US based. So figuring out which is the best one for the tax classification, it's usually better off using an EMD advisor. But having said that, if you like doing everything on your own and you don't want to work with anyone else, then you want option one. Go do your own homework, figure out the best way to do it. It's probably the most inefficient way to do it, but if that's the way that you want to do it, you can. If you want and you need some help over here, then you want to try to talk to somebody who's already doing it for their clients. So, thank you guys for listening to me. I hope this was helpful. I'm here to just educate as many people as I possibly can over here. If you did want to connect with me, it's not hard to find me, latitude-west.ca. You can scan the QR code or fire me an email. In general, thank you guys very much, and I hope to see you guys at the next video.